This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Hello. We're going to be looking at changes in group structure. This is new to you in SBR, so you will not have seen it before in financial reporting. In financial reporting, you learned how to deal with accounting for a subsidiary. You learned how to deal with accounting for an associate. Changes in group structure looks at the situation when the parent company either buys or sells additional shares in the year, meaning that what was an associate at the start of the year may end up as a subsidiary, or what was a subsidiary at the start of the year may end up as an associate. So we have to think about some of the impacts of that, particularly on calculations like goodwill. As with the rest of group accounts, you will not be asked to construct a whole consolidation, but you might be asked to do certain calculations, in particular, of course, goodwill. And there are various permutations that we'll see as we go through the notes. So you can see the scene is set in our course notes at the top there, where it says that a change in group structure is if the parent company buys more shares in an entity or sells shares in the entity. Now, a bit like a lift or elevator or escalator, you can either go up or go down. So we're going to look at going up first. A word that they sometimes use for going up is step acquisitions. You'll never see it in a requirement really as a term. You don't need to use it particularly, but it's just a convenient phrase where you own some shares and then buy some more. We're going to look at two different situations. The first one is where you go from a position of no control and then you actually get control. So what could that mean? It could mean, for example, that you go from, let's say, 15% to 70%. You cross the magic threshold, don't you? The magic threshold is more than 50%. As soon as you get 50%, just over 50%, you can appoint directors, and you can appoint all the directors, and no one else has any real power. You have control. So it could be going from a regular trade investment up into a subsidiary, or it could be going from an associate, like 25% to 70%. In both cases, the treatment is exactly the same. The big important thing to understand, I think, is that you did have something and now you don't, and you have something new. I sometimes think about this. The analogy is the caterpillar. One night the caterpillar goes to bed, and when the caterpillar wakes up this morning, the next morning, it's a beautiful butterfly. So when you go from 15 or 25 up to 70, you say goodbye to the old investment, bye-bye, and you say hello to the new investment. Goodbye to the old investment, hello to the new investment. Now, what effectively happens, it's quite hard sometimes, I think, to put this into words, but it's easier, much easier with the numbers. But if I look at the text down here, it says the accounting treatment is to treat the original investment as being disposed of at fair value. So, in a sense, that's step one. Step one, bye-bye to the old investment. And we actually work out a profit on sale by looking at the carrying amount and the fair value. We say bye-bye to the carrying amount and hello to the fair value, which is what I suppose you could sell the investment for cash. So we're saying goodbye to the old investment. That's the 15% or the 25%. And now we say hello to the new investment. We say hello to the 70. When you have a subsidiary in your books for the first time, of course, you have to calculate goodwill. So essentially, here is step 2. We have to calculate the goodwill. You can see the 2 steps down there. When we calculate the goodwill, you've got the cost of the new slice of the business, the value of the old slice of the business because we bought it in 2 lumps, compared to the net assets acquired. Everything is measured at fair value. IFRS 3 is very, very dictatorial. It's like a dictatorship, and it says when you get control, you must on that date calculate goodwill, and everything must be measured at fair value. Now, this sentence that I'm highlighting now looks a bit odd. It's easier when we try the numbers in a minute. As it says, the fair value, that's of the original investment, plus anything else you've paid, will become the cost of the increased investment. I bought it in 2 slices, like buying a pair of shoes where you might buy 1 pair on Monday and 1 pair a month. One shoe on Monday and 1 shoe a week later. Well, you might do, I suppose. So you've got 2 lumps of investment, the original shoe and the new shoe, to make a nice pair. But it's a 2-stage process, you can see here. The old investment says bye-bye. The gain usually goes to profit and loss. There is an exception that we'll see later when we get to financial instruments. But for the moment, I'm just going to say, in most cases, the gain ends up in the profit and loss. So we can see, if we look down here, an actual calculation of the goodwill. It looks like a regular calculation, except it's got an extra line. So when you look here, essentially, this is actually, isn't it? This is P's stake in the business. Can I use the word stake? I think so. Not steak and chips, but stake as in having a stake, an investment. So you take the cost of the additional investment. That's what you're paying for today. In my example, the extra 55% or the extra 45% of going from 15 or 25 to 70. That comes in at cost. The original investment, again, is coming in at fair value. The rest of the goodwill is just a regular calculation. So we do a working for goodwill. There'll also be another working, if needed, and that will be on the disposal of the old investment. Some people say it's a revaluation. You can say that if you like. I think it's easier conceptually to think of it as a disposal. That calculation, it's coming back here to the yellow words. Well, it's the difference between the fair value of the old investment, so the fair value, and its carrying amount. Now, the only problem is if it's an associate, because if it's an associate, then it means you've got to use equity accounting. And as we all know, we hate equity accounting. Well, I like it, but most people hate it. But the difference between the fair value of the old investment and the carrying amount usually goes to P&L. I say there is an exception that we'll meet later in financial instruments. So you start with something at this value, it goes up to the fair value. That fair value is then locked into the goodwill calculation. The difference between the old carrying amount and this new fair value, normally to profit and loss. The key thing here is that this number with the nice red circle is this number. I'll draw a little arrow across there. So it's used in the two places. Let's have a look at an example, and you'll see several as you practice past questions. Anyway, it's nothing to be too intimidated by. Please pause the recording and have a read of Jeremy. So, many years ago, Jeremy bought David for 40. The value of that will change, and we can see in 2015, the value of that investment is now 52. It could be that you've forgotten this jargon, fair value through profit or loss. It's one of the categories that investments can be classed under. It means it's measured at fair value. Gains and losses go to profit and loss. If you've forgotten it, don't worry, you'll see it when you do financial instruments, but it just means it keeps getting revalued. Anyway, what we've got here, or it's supposed to, assume for a moment that 40 is still in the accounts. That now will be revalued to 52, and the 52 will be the figure that's used in the goodwill. In this particular group, with David, what's happening in terms of group structure is that we are going from 40% up to 75%. That's right, isn't it? Some of you might be saying, well, I think that's an associate. It could be. If it was an associate, it would say, this is an associate. Remember from when we learned about associates, it's not the percentage, it's whether you have significant influence. There's no reference to significant influence, so don't start making a fight about this and say it's an associate. No, it's not. It's only an associate if they've got significant influence. Anyway, it's a regular investment. So we need to calculate the goodwill. So we set down our pro forma first of all. So let's have a look at this little example. Pause the recording if you want and then have a go. But in this particular situation, we've gone from 40 to 75. So I've got the cost of the 35%. Again, don't go back and try and find it, just pro forma it first. The fair value of the 40%, that's the original stake, and the NCI less the net assets. And once I've done that, goodwill will drop out. So back we go to the scenario, just highlighting in green the numbers that look as if they might be significant. So the cost of the 35% is 45. The fair value of the 40% is 52. The NCI is measured at fair value, and that is 32. And the net assets they must be somewhere, have got a fair value of 105. So 45 plus 52 plus 32 minus 105 would give me goodwill of 24. 24. I'm just putting a little note that says the gain on the original 40% stake or investment goes to profit and loss, and that gain is the difference between the fair value, 52, and the original cost, which was, back up here, 40. It may be that that's been revalued along the way over the years. It's not very clear in the scenario, but either way, the existing carrying amount and the fair value would be compared, and the difference would go to profit and loss. That's the situation where you achieve control. We're going to look at one more example of a step acquisition, but a slightly different scenario. And that's just across the page. There's a very strange heading, isn't there? Control to control. So what's that talking about? Well, it means, for example, what happens if you went from 80% to 90%? And it sounds like a traditional acquisition, doesn't it? It sounds like you've bought something. It sounds like there ought to be some goodwill. However, IFRS 3 is a very militant accounting standard. It was developed as a joint project between the International Standards Board and the US authorities, and you have to read it very literally. The standard says you shall calculate goodwill when you get control, and only when you get control. So you can't calculate more goodwill, and the best answer I'm going to give you is because the standard says so. Over the years, I've seen lots of different treatments. This isn't my favourite, but that's irrelevant, isn't it? This is what we have to do. There has been no more control, so there will be no change to goodwill. That's important. What has changed? If you went from 80 to 90, two things have changed. Some money will have been paid out because essentially you'll have bought up some shares, and the NCI will get smaller. Now, I sometimes think about this. If you had a lodger in your house and the lodger was a complete nuisance, insisted watching television that you hate all day, and left their dirty washing all over the house, and then the time came for you to throw them out, so you paid them some money to go away, and they went away. So you could watch what you wanted on the TV, and your bathroom was now clear. So the only issue with this is that the money that you pay out will not be the same as the change in the NCI. It just won't be, because one's like a percentage of a carrying amount, and the other is a figure, a money figure that you've negotiated to buy up those shares. So there'll be a difference. So the IASB said, what shall we call this? Well, they call it the difference, or more commonly, I think, the adjustment. They said, here is an adjustment. Where shall we put it? Can you put something called adjustment in the profit and loss? No, they'd be marching in the streets. Can you put an adjustment in OCI? No, they'd be marching in the streets. So where do we put it? We put it in reserves. It goes into the statement of changes in equity as an adjustment. When you write this up, what is very important is that you write the sentence, this does not go in the profit and loss or OCI. It is not perceived to be a gain or loss. And you'll see that what they say is, this is really a transaction with the NCI shareholders. It's an equity transaction. People frequently say, well, which reserve? And when I look at model answers, they seem to vary all over the place. So it can go to retained earnings. Other answers I've seen have put it in OCE, other components of equity. Would I be losing sleep? No, so not really bothered. The main thing is that it doesn't go in the profit and loss and it doesn't go in OCI. But I think I've said that 7 times. I know in the notes I've said that the adjustment is being swept under the carpet. I probably wouldn't use that phrase in the exam actually, because they'd probably say, well, we think it's a much more important reason. The official reason is the one I'm now highlighting, and that is it's a transaction with the NCI shareholders. So when you go from 80 to 90, the NCI gets smaller, cash goes out, there's a difference. The difference goes somewhere through reserves. You might say, why is the New York Times or the Financial Times not full of people writing in and saying this is disgusting? It's because it's so obscure, isn't it, that nobody would spot it except an accountant. And even then, I think not many accountants. And it's just too dull at the end of the day for people to write to the papers. I think if it had gone to the profit and loss, people would have got a bit excited. There we are. So impact is NCI goes down. If you like double entry, that's a debit. Cash goes down. If you like double entry, that's a credit. And there will be an adjustment. And that adjustment, as it says there, goes to reserves. It could be a debit or a credit, depends which way you're going. The only thing you have to be a little bit careful with is deciding by how much the NCI has changed. So pause the tape for a moment and please read example 2. So in example 2, I am going from 75% to 100%. The NCI is therefore going from 25% to nothing. So let's have a look at this. Let's have a look at the little calculation. Example 2. So first of all, I've got the money I pay out, the consideration. How much did I pay? I paid 100. So the cash paid is 100. Double entry, credit cash. As always, you don't have to write credit. You can just say this goes up, this goes down. Now I've got the change in NCI. You do need to think about this and try not to get too mathsy about it. Just think about it from common sense. The NCI was originally 75. Again, what is it now? It's not going to say in the question, is it? You just have to think for a minute. The NCI is now going to be nothing because we have no NCI today. Bye-bye, NCI. So that's going from 75 to 0. That's a change of 75. Debit NCI, which remember is a credit balance, or if you prefer, this goes down. The difference or the adjustment, I tend to say, to the statement of changes in equity, but not to P&L and not to OCI, is 25. Well, it's a balancing figure, so that will reduce retained earnings. It's a debit. It is a reduction, effectively, again. Is it a loss? Of course it's not a loss. It's simply a book entry to make the books balance. Otherwise, we'd have a balance sheet which didn't balance, and then people would start to get very upset indeed. So that is step acquisitions.